WMT, Walmart, reported $177.75 billion in Q1 FY 2027 revenue, $2.9 billion above consensus, and earnings per share of 66 cents against the 65 cents expected. On the surface, the numbers confirm the thesis that has driven WMT up 17.8% year-to-date, well ahead of the S&P 500's 10.4%. But the beat arrived the same week gas prices hit $4.55 a gallon nationally, a number that wasn't in any analyst's model. The beat itself is not the question. The question is what the beat was built on, and whether that foundation survives what is arriving after the quarter closed. Revenue grew 7.4% year-over-year, driven by higher transaction counts, e-commerce momentum, and gains in advertising and membership revenue. Those are not the metrics of a retailer under consumer pressure. They are the metrics of a retailer taking share. That share gain, however, came disproportionately from higher-income households trading down into WMT, a shift that has been running for roughly 6 quarters. The recession resilience thesis was originally underwritten by WMT's deep penetration of low-income consumers who have no alternative to its price points. The higher income migration adds a new support layer, but it does not replace the original one. CEO John Furner said on the earnings call that higher fuel prices are beginning to affect lower-income consumer behavior. That sentence warrants attention precisely because it was not in the revenue line yet. Q1 closed before the Memorial Day gas price reading of $4.55 was fully absorbed into household spending decisions. Furner was describing a behavioral shift in motion, not one already captured in the quarter's numbers. The Q1 beat is therefore a measurement of where the consumer was, not where the consumer is heading, and those two states have diverged by the exact threshold Furner named.
The number that reframes the entire Q1 beat is not $177.75 billion. It is $4.50. Walmart's own earnings call established that gas prices above $4.50 per gallon historically correlate with meaningful spending pullbacks in discretionary categories among its core consumer demographic. That threshold is not an external analyst estimate. It came from WMT's own data, cited by the CEO on the call in which the beat was announced. Gas prices on May 22 averaged $4.55 nationally. The threshold has been crossed, and the quarter that documented the crossing has not yet begun. This is where the Iran war's transmission into WMT's business becomes structural rather than atmospheric. The U.S. Israel attack on Iran began February 28. By Memorial Day, average gas prices were more than 50% higher than pre-war levels. Americans spent $2 billion more on gasoline over Memorial Day weekend than the prior year, roughly $22 million more per hour. That incremental $22 million per hour is not new consumer spending. It is a reallocation from other categories, and WMT's low-income consumer base has the least capacity to absorb the reallocation without cutting elsewhere. The counter-signal that capital markets are currently pricing, the one that explains why WMT still trades near its highs despite this, is that Strait of Hormuz resolution arrives before consumer damage becomes permanent. Wall Street is pricing in Iran conflict resolution before demand destruction becomes structural. That is a timing bet, not a fundamental one, and it carries a specific invalidation condition. If Brent crude remains above $100 through June and average U.S. gas prices approach $5, the resolution assumption collapses before it can rescue the Q1 thesis. The energy pass-through to consumer goods is still working through supply chains, according to reporting on the oil price shock's duration. That phrase, still working through, is the residue the Q1 beat does not address. The beat captured transactions and revenue before the full cost pass-through reached shelf prices. The next quarter's comps will be measured against a period when that pass-through is no longer incoming but present. Walmart raised its annual revenue guidance modestly, which signals management confidence. But guidance revisions calibrated before the 4.55 reading may require a second look if the strait remains close through June. The guidance raise is not a guarantee. It is a conditional statement whose condition is the one now in active dispute.
The Iran war gas shock does not hit WMT and TGT symmetrically, and that asymmetry is where the relative value question becomes an allocation question. Target reported Q1 results the same week as WMT, with modest same-store sales improvement, but CEO Brian Cornell flagged traffic headwinds in discretionary categories, driven by fuel cost sensitivity among its core consumer demographic. TGT's core consumer skews toward middle-income households with a higher proportion of discretionary spending, apparel, home goods, electronics, relative to WMT's grocery-heavy mix. That means TGT absorbs gas price shocks through a different transmission channel, not a spending pullback on staples, but a reduction in the discretionary trips that drive its traffic model. WMT is more indexed to groceries, where demand is inelastic. TGT is more indexed to general merchandise, where demand shrinks when the household budget is compressed. At $4.55 gas, both CEOs flag the same pressure, but they are describing different mechanisms. WMT's risk is that its low-income base stops buying discretionary items within Walmart, which compresses basket size even as traffic holds. TGT's risk is that its middle-income base reduces trip frequency altogether, which compresses both traffic and basket simultaneously. The distinction matters for the relative value frame because WMT has traded at a significant premium to TGT year-to-date, WMT up 17.8%, TGT down meaningfully, with Home Depot down 13.5% as the reference point for how badly discretionary adjacent retail has been hit. That premium was purchased on the thesis that WMT's staples orientation insulates it from exactly the kind of shock now unfolding. If basket compression arrives in Q2, lower discretionary add-ons per grocery trip, the premium narrows not because TGT improves, but because WMT's insulation premium was overstated. The point most participants have not yet priced, TGT's early-stage turnaround, which is showing initial traction, was calibrated for a neutral to slightly favorable macro backdrop. Cornell noted the company is in early stages of the turnaround. That caveat was spoken into a $4.55 gas environment. The turnaround's margin structure assumes a consumer who is showing up and trading across categories. A consumer whose disposable income is being reallocated to the gas pump is not that consumer. TGT's recovery optionality, which was beginning to attract positioning, faces a sequencing problem. The turnaround momentum arrived at the same moment the consumer headwind it least needs also arrived. The participant timing structure here is visible. Institutional capital that moved into WMT early in 2026 on the staples premium thesis has not yet repositioned. Retail positioning in WMT has not shown a net exit pattern. The flow that has not yet confirmed the move is institutional rotation out of the WMT premium into something that prices the gas shock duration more accurately. That rotation is the signal to watch, not the Q1 headline.
The same week, WMT reported its Q1 beat. CEO John Furner sold 13,125 shares at $124.08 for $1.63 million, and EVP Christopher Nicholas sold 2,900 shares at $123.92 under prearranged 10b5-1 plans. Both executives are selling near the stock's 2026 highs. The 10b5-1 designation means these sales were scheduled before the earnings date and carry no legal informational content about the Q2 outlook. That is the standard reading, and it is correct as far as it goes. What it does not settle is the question of why these plans were initiated at this price level in the first place, and whether the timing of plan establishment, which precedes execution by months, reflects any executive judgment about the stock's position relative to forward risk. Furner retains 661,037 shares, valued at approximately $80 million, which means the sale represents a small fraction of his total position. The insider flow here is not a distribution signal. It is too small against the retained position to read as conviction selling. The more relevant observation is that these sales execute at a moment when the stock's premium relative to the sector is near its widest in years, and the catalyst that could compress that premium is now above the CEO's own stated threshold. The holding period question this creates is not whether to sell WMT, but on what horizon the current premium is defensible. The WMT staples premium thesis has a clear invalidation trigger: 2 consecutive quarters of U.S. comp deceleration in non-grocery categories, coinciding with gas prices that remain above $4.5. The first deceleration signal is in the Q1 data already. U.S. comps excluding fuel came in at 3.86%, down from 4.6% the prior quarter. That deceleration happened before the 4.55 reading was fully absorbed. If the same directional trend appears in Q2 comps, the premium compression trade becomes a positioning consensus, not a contrarian call. The Fed's current stance amplifies the holding period risk. The April FOMC meeting produced 4 dissents, the most divided meeting since 1992, with a majority of participants flagging that some policy tightening may become appropriate if inflation runs persistently above 2%. PCE inflation reached an estimated 3.5% in March. A rate environment that stays restrictive for longer than expected does not directly impair WMT's grocery business, but it does tighten the household budget further for the low-income consumer who is already absorbing 4.55 gas. The Fed's posture and the gas price trajectory are not independent risks. They are compounding pressures on the same consumer cohort. The 4.55 number will either normalize toward 4 as Strait of Hormuz negotiations progress, or approach 5 if they stall. That is the variable WMT holders are actually managing, not the Q1 beat that has already been priced. The beat confirmed where the floor was. The gas price determines whether the floor holds. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.